All homeowners will have to pay for homeowners insurance, but some buyers will have to pay for additional insurance coverage called PMI, private mortgage insurance. This kind of insurance, however, does not provide protection coverage for the homeowner. It's intended to protect the lender, typically when a buyer pays less than 20% down, because the lender will, in this case, view the mortgage loan as a riskier investment. But there is some ways to avoid paying for PMI, even with a smaller down payment. Although private mortgage insurance doesn't provide any protection against foreclosure, it does allow people who can't afford a 20% down payment to become homeowners. If you're in that boat, your lender will coordinate with a private insurance provider to determine whether and how much you will pay for PMI. The good news is that you won't have to pay PMI throughout the life of the loan. Once you've reached the 20% equity, you can remove that PMI. This can happen either through paying down your loan balance or by your home increasing in value, equity, or the combination of both. Typically, servicers are required to terminate the PMI when your loan value reaches 78% of your home's original value. So what's the cost of PMI? So how much you will have to pay for private mortgage insurance? It usually runs annually between 0.4% and up to 2.25%, the whole mortgage loan amount. And that can increase your monthly mortgage payment by not a little. How much you actually pay for PMI as a Eugene homebuyer depends primarily on two factors. Loan to value ratio. This ratio is determined by how much you put down. For example, if you put 15%, your loan to value ratio will be 85%. Another one is your credit score. Credit history and credit score also play a role in how much you'll pay for PMI. The higher your credit score, the less you'll pay. So how do you avoid PMI? Now, there is a way for Eugene homebuyers to avoid paying for PMI, even when they put down less than 20%. If you can't afford a 20% down payment, you can't get around the PMI by taking out two loans. One loan, of course, will be the mortgage to buy the home, and the other will be a smaller loan to cover the 20% down payment. This practice is known as piggybacking. Doing this will allow you to have a smaller monthly mortgage payment because the PMI charge won't be added. And you may also be able to deduct the interest on both loans at tax time. Ultimately, though, many buyers find they have to pay for the private mortgage insurance because they can't afford to put the 20% down and can't qualify for a second loan to cover that 20% down payment. PMI may be worth it for them, especially if you're a first-time home buyer. They can become homeowners and may be able to deduct the cost of the PMI if they meet the income limitation requirements.